Hello, everyone. Welcome back to our discussion of Chapter 9 and tax credits. I just wanted to point out in our Part 1, this is Part 2, before we get to this foreign tax credit, the two that we talked about in the first one, the child care credit, is now fully refundable. It used to be non-refundable. It is now fully refundable for 2021. And that means that it can create, like we mentioned at the start of the part one, we can give you a refund. In the second one, the education credits, the American Opportunity Credit is partially refundable, up to 40%. So that one's the most crazy of all, in that it is partially refundable and partially non-refundable. On the tax return and when you're doing any calculations, you always want to do the non-refundable credits first, right? Because that wipes out, because they can't create a refund. But so you leave your refundable ones to calculate as a refund after you've covered your tax liability with non-refundable credits. All right, so foreign tax credit, a non-refundable credit, okay? And you can see it really wouldn't make sense to be refundable anyway, because this situation is where we've paid income tax in another country. So as a U.S. citizen, we've had investments in another country. We haven't necessarily been there or lived there or worked there. Chances are, if you have substantial time in another country, that you are better off with the exclusion of foreign source income. But this is, you had an investment there, or maybe something, or in some way, a small portion, but you earned income in that country and they withheld taxes. You paid in some way, okay? So your credit, you're going to get credit for those taxes that you paid towards your U.S. income tax, but only to the extent that you would have paid taxes in the United States. So how we do that, we basically take your whole amount of income, you take the amount that was from that particular country, and divide it by your total, okay? You calculate your taxes in the United States on your total income, your worldwide income. So it doesn't really matter where it came from, where you earned it. You take that total, and what you're going to do is you're going to take that percentage that of your total that is earned in that country, and you're going to multiply it by what your income tax is in the United States. That's the income tax attributable to that foreign income. Okay? So those are the two limits, okay? So it's either the lesser of the amount of income tax you paid in that country, or the amount of tax you would have paid if you would have had that income in the United States. So, example, Joy has 63,000 worldwide taxable income, 8,000 in New Zealand. She paid taxes in New Zealand, 2,500. Her total U.S. tax liability is 17,640, right? That's on all 63,000. So you take your 8,000 that was earned in New Zealand, you divide it by the 63,000, you get a percentage, and then you multiply it by your total tax that you would have paid on all your income in the United States. And so that part of your tax is 2240. So you get a tax credit of the lower between the 2,500 that was actually paid in New Zealand and the 2240. So the 2240 wins this time. Okay? And if it would have been we paid more tax, we didn't get the credit for all the tax we paid. If the taxes would have been lower than the 2240, then that would have been the amount of the credit. All right, the child tax credit expanded for 2021. Okay, made fully refundable. All right, so it is fully refundable. We're talking about children, qualified children, same definition we talked about way back in chapter 2, okay? Age 17 or under. So as soon as they turn 18, doesn't count for this, okay? The child tax credit, there is a credit for other dependents. That's right down there at the bottom, non-refundable credit. That's non-refundable for qualified dependents other than children. So as soon as they hit 18, they may still be a dependent, but it's only $500 instead of the $3,000 we see there. 6 to 17, under 6. Okay, so we got 2 age ranges, $3,600. And it does have a phase out, okay, when you get to, there's actually 2 phase outs, which is really confusing, but 2 phase outs, one for the extra because the old tax credit was $2,000, so the additional $1,000 or $1,600 is phased out and with 1 phase out range, and then the $2,000 phases out in a second phase out range. Okay, so that's what we're talking about here. The first phase out range starts at 75, single 112, 500 head of household, and 150 for married filing jointly. So it's reduced by 5% of the AGI in excess of those amounts. So, example, 82,000, 1 child tax credit would be $2,650 because you're over by 7,000. You multiply that by 5%, 7,000 times 5%, it's 350. Okay, and then you take that from the 3,000 to get 2,650. You do that until you would have gotten down to 2,000, right? And then it can't go below that because of this phase out range. So it phases out in that way, and then the second phase out kicks in at 400,000 for married jointly and for 200,000 for everyone else. Okay, and so this phase out is quite high compared to the other one. This is when we start digging into the $2,000 credit. And this is reduced not the same way, not as a percentage, but by $50 for each $1,000 or fraction thereof in excess of the amounts. Okay? So there's single taxpayer, AGI 217. Tax credit would be 150 because $50, we're at 17 1,000s over the AGI threshold. And so you take 17 times 50, that would be your 850, and you would subtract that to get your 1150 remaining tax credit. Now, tricky part, if it is 217,100, it wouldn't be 17, it would be 18. You always round up. That's what it means by it says, or fraction thereof. So every, even at $1 or more, AGI would put you one more phase out. Okay? One more $50 phase out. Example, 2 qualifying children, ages 8 and 11, file jointly, AGI is 112. Okay? So $3,000 per child, they're not, either one of them is under 6, so you don't get the 3,600, 6,000 in total. All right, and the first phase out range for married filing jointly is 150,000, so we haven't hit that, so they get the full $6,000 credit. Okay, situation that we talked about earlier, age 18, true or false is not permitted to change over 17. Okay. And then the situation, a situation of other dependent, right? Not a child, clearly not a child, therefore not $3,000, it's $500 credit. And again, that is non-refundable versus the others that are refundable. Okay? And they have to qualify as a dependent. Remember our tests from back in Chapter 2. All right, retirement savings credit. Make a contribution to a retirement plan, 401k, simple plan, IRA, Roth IRA. Okay, this is actually a double benefit because most of these situations you don't have to include the amount you put in your income, so you get a tax deduction and you get a credit. So it's one of the few places in the tax law where you actually get double dipping or double benefit for the same amount, but it only applies to people with fairly low income levels. So it goes away pretty quickly as your income goes up. Okay, it's a percentage of what you contributed to your retirement account, and the most that you can consider is $2,000. So no matter how much you put in, the most you can consider towards the credit is $2,000 per person. And so what percentage you use or what percentage of what you put in, okay, depends on your income. So notice that for joint filers, okay, as soon as you get to up to $39,500, okay, you get a 50% credit. So if you put $1,500 in, you'd get a $750 credit. Then you see it goes down pretty fast. It goes from 50 to 20 as soon as you go over 39,500. And if you go over 43,000, it goes clear down from 20 to 10, and at 66,000, which is a great deal of income, okay, it is 0, okay? So it doesn't apply. A couple of examples. 52,000 married filing jointly, contribute $1,500. Okay, we look at our table. We see that they are between 43 and 66. They get a 10% credit. They put in $1,500. It's $150. Okay, Roger, okay, has 26,000. He managed to make a $2,200 contribution, but he can only consider $2,000. But he is low enough. The income is low enough to be 50%, right? Because he is head of household. So he's here in this middle. So as long as it's under 29,625, okay, he gets 50%, but only on the $2,000 limit, $1,000 credit. Adoption credit. 100% of qualified adoption expenses. It can be quite expensive to go through the adoption process. Okay, has to be finalized in the year that you are talking about. 14, but there's a maximum. Okay, you can't consider expenses over. This is non-refundable, by the way. $14,440 per child. So I get more than one child if you adopted. Then you could have more, the higher. And you have to file jointly, okay? And it phases out, all right? Begins at 216 and is completely gone by 256, 660, okay? So again, you have to calculate if you're over the 216, 660, and that gets adjusted each year. That's why it's such an odd number. It just keeps getting adjusted, all right? Tentative credit is multiplied by the fraction as you look at how much is phased out. So Levi, Isaiah incur the following expenses in adoption of their infant daughter, which was finalized in 2021. Notice that they can use expenses from the previous year when it wasn't adopted, because this process can be a long time. Okay, so that doesn't happen until 2021, but you could still use expenses you paid in 2020. Add them together, they're over the limit, right? Okay. So they don't do anything in 2020 because adoption is not final. Right? 1440 is the limit in 2021 because their expenses are more than that. Okay, so you take the lower of the two, not by much, but a little bit. Okay, and they're not over the phase-out range or into the phase-out range, so they don't have to worry about the phase-out. Okay, this situation 16,000 is more than the maximum by a decent amount, okay? So the 1440 is used, but then we have the phase out situation because they're over the phase out. Now this calculation they used here, okay, is actually from the bottom. So we took and subtracted the 256, 660 minus the 236. Okay, that's the top of the phase out range minus where we are. Okay, that's how much is left of our credit, 74.58. So if you that's calculating how much is left if you use your income compared to the bottom part of the range. Then you're figuring out, and you do that calculation, you figure out how much is disallowed. You'd subtract it after you were done. So this is maybe a little shorter, however you prefer to calculate it. Earned income credit. Okay, this is for those with earned, so it only qualifies for those who have report income as from wages, business, that sort of thing. It is refundable. It's based on your filing status, children, although there is a small amount for those with no children, but it's much, much, much less than with children, okay? And earned income. And basically what happens is as your income increases, earned income that is, the credit increases. And then it hits a plateau and it's the same for a certain level of income, and then it starts to phase out. As your income gets high enough, then it doesn't apply anymore. Okay? If you have too much investment income, you are ineligible. So first step in this is to make sure that that's not the case. That if they have too much investment income. Now, $10,000 is a lot of investment income. So yes, that would be very rare that would disqualify anyone. But if that is the case, that would put you out of the earned income credit. And you can see the maximum, okay, earned income credit amounts. One child, 36.18, 59.80, 67.28. This is the most you could get that you hit that sweet spot. Not income too low, not income too high, but income in the middle, okay? And you see no children being much lower than with children. So I think the best way to do the earned income credit calculation is to look up the amounts in the earned income credit tables. Now, here's what you need to do. You have to do it twice, assuming that it's different numbers. So you look up on the earned income credit tables, and this is a separate table from the tax table, and it's actually linked in your electronic book to chapter 9. You look it up AGI first, and then you look up earned income. Now, many times that's the same number, so you don't have to do it twice. But if those two are different, then you have to look them up different and take the lowest of the two. And when you look at the table, you're going to have to know how many children and their filing status. Okay? Now, you can also do it using the formula, but that's always a little bit more tricky. Okay? And in this case, they're starting to see some of the phase out happen. Okay, so the earned income credit is only $25.75 instead of $36.18. Now, you should get basically the same thing with the $32,000 if you looked it up on the tables. I just think looking it up on the tables is easier and less likely to make a mistake because the formula is a little bit tricky. So Tiffany is the head of household. She earned $16,000. What is her credit? We look it up. Okay. And her tax liability before that is $800. So their credit is $59.80, given 2 children, head of household. Tax liability is $800, so she's going to get $51.80 back. All right, our last credit, premium tax credit. While there's no penalty for not having health insurance in the law currently, if you use the marketplace, this is only if you use the health insurance marketplace, premium tax credit may be available. It's based on your income level, how much you're supposed to be, a formula to figure out what you should be able to afford for health insurance versus what it actually costs. And the credit is kind of the calculation of the difference, all right, between the two. And that it's non-refundable, okay? You'll get all the information on a 1095-A form from the insurance company. You'll compare what you should be, what you can afford based on your income with how much you actually were charged. Now, what happens when you buy it from the marketplace, okay, is that they look at your estimated income for the coming year, and they reduce the premium you have to pay by the credit, because basically the insurance company is going to apply on your behalf and get some of that money from the government to cover your insurance costs. Okay, so you could receive more benefit than you should. Right now, under the current law, that's not required to be repaid. So you only can get money, a benefit out of the premium tax credit. You don't have to pay back if you got too much if your income ends up being higher than what it was you intended it to be, or what you thought it was going to be for the year.